What if I told you that the world's most powerful economy is built on centuries of trust, innovation, and progress nearly collapsed overnight? Not because of war, not because of a natural disaster, but because of greed. In 2008, a financial hurricane tore through the global economy, wiping out trillions of dollars, destroying millions of jobs, and leaving behind a world that has never truly recovered. But here is the mystery. How could something so catastrophic, so obvious in hindsight, go unnoticed by the smartest people in finance, government, and academia? How could banks, regulators, and investors, people who literally study risk for a living, create a system destined to fail? This isn't just a story about numbers. It's a story about human psychology, fear, greed, and denial playing out on a global scale. And by the end of this video, you'll see why the 2008 crisis wasn't a one-time mistake. It was a warning one that we may already be ignoring again. The stage 4 disaster was set in the 1990s and early 2000s. The US economy was thriving, unemployment was low, stock markets were booming, and most importantly, housing prices never seemed to fall. Owning a home wasn't just part of the American dream, it was asterisk. The asterisk dream. Banks loved it, politicians loved it, and Wall Street turned it into their golden goose. But behind the dream, a machine built on debt was forming a system that rewarded risk, punished caution, and ignored reality. To understand how this machine worked, we need to meet the key players. First, the big banks like Lehman Brothers, Bear Stearns, Goldman Sachs, and Citigroup. They didn't just lend money. They created money-like products out of mortgages. The more loans they made, the more profit they earned. And soon, that simple equation, more loans equals more profit, would become toxic. Next, the home. Ordinary people were told, why rent when you can own? Banks offered mortgages to almost anyone, even people with low income, no savings, or unstable jobs. These were called subprime loans, given to borrowers who probably couldn't pay them back. But that didn't matter, because the banks didn't plan to keep these risky loans. This is where the madness begins. Wall Street's alchemists took thousands of these risky mortgages, bundled them together, and turned them into financial products called mortgage-backed securities, or MBS. Imagine collecting thousands of shaky IOUs and pretending that, together, they were safe. Then, they chopped these bundles into pieces called transsesum safe, some risky, and sold them to investors all over the world. On paper, it looked like risk had been diversified. In reality, it had just been spread like a virus. You might be thinking, surely someone checked the safety of these investments. That was the job of credit rating agencies like Moody's and Standard & Poor's. They were supposed to be the referees. But here, as the catch, the banks paid the rating agencies to rate their products. You don't have to be an economist to see the conflict of interest. So, they handed out AAA ratings, the highest possible grade 2 investments built on sand. From pension funds to European banks, investors around the world bought these assets, thinking they were safe. It was global trust, built on global ignorance. After the dot-com crash in 2000 and the 9/11 attacks, the US government wanted to keep the economy growing. The Federal Reserve, led by Alan Greenspan, cut interest rates to historic lows. Cheap money flooded the system. Borrowing was easy, and Wall Street needed somewhere to put all that money. Housing was perfect. You could see it, touch it, believe in it. And with each passing year, home prices kept climbing. Everyone felt rich, but no one stopped to ask, what happens if home prices stop going up? Between 2001 and 2006, subprime lending exploded. Banks and mortgage brokers were handing out loans like candy. No income verification. No problem. No down payment. You're approved. These became known as ninja loans. No income, no job, no assets. Some loan officers even joked they could lend money to a dog and still get it approved. And here's the kicker. Many borrowers didn't even understand the terms. They were told their payments would stay low, but those were teaser rates, temporary, set to skyrocket later. The logic was simple. By the time payments increased, they'd just refinance, because housing prices would just keep rising. But nothing grows forever. By 2006, the housing market was feverish. Ordinary people quit their jobs to become house flippers. Banks invented new products to keep the profits rolling. And Wall Street took the madness global, creating ever more complex products like collateralized debt obligations, or ACDO was a Frankenstein monster of mortgage bundled, sliced, and sold multiple times. Each layer was farther removed from the actual homeowner, and each layer made someone rich. Greed wasn't just tolerated, it was glorified. Everyone believed the system was unbreakable, but beneath the surface, cracks were forming. In 2006, the impossible happened. Housing prices stopped rising. Then they started to fall. Suddenly, homeowners with huge loans realized their houses were worth less than their mortgages. They stopped paying. Foreclosures began to rise. At first, the banks brushed it off. It's just the subprime market, they said. But remember those MBS and CD that were built on these same loans? And those loans were now failing en masse. Investors panicked. The value of mortgage-backed assets plummeted. Banks that had borrowed billions against these now toxic assets couldn't cover their debts. One by one, the giants began to fall. Bear Stearns collapsed in March 2008. Lehman Brothers, a 158-year-old institution, declared bankruptcy that September, the largest in U.S. history. AIG, the world's biggest insurance company, needed a government bailout. The entire financial system froze. Banks stopped lending to each other because no one knew who was holding the next ticking time bomb. Credit, the lifeblood of modern economies, vanished overnight. The panic spread worldwide. European banks had bought U.S. mortgage products. Asian markets tumbled. Millions lost their homes. Millions more lost their jobs. Entire countries slipped into recession. It wasn't just numbers on a screen, it was real lives shattered. By late 2008, the financial system was in free fall. The U.S. government stepped in with a $700 billion bailout called TARP, the Troubled Asset Relief Program. The Federal Reserve slashed interest rates to near zero and began pumping money into the system through quantitative easing, essentially printing money to buy assets. It worked, temporarily. The bleeding stopped, but the deeper wounds, trust, accountability, fairness, remained open. And here's the tragedy. The people who caused the crash walked away mostly unscathed. Top bankers got bonuses. Few were prosecuted, but ordinary people, the ones who lost their homes, savings, and jobs, were left behind. The rich recovered quickly. The poor never fully did. The system was saved, but not fixed. After the crisis, governments promised reform. The Dodd-Frank Act tried to regulate risky behavior and increase transparency. But Wall Street adapted. They found new loopholes, new products, new ways to gamble. The same incentives remained. Short-term profits, long-term risk. And by the 2020s, global debt had soared higher than ever. Sound familiar? Fast forward to today. The lessons of 2008 echo everywhere. The rise of cryptocurrency speculation, where billions were poured into digital assets many didn't understand. The meme stock mania of 2021, where markets moved on emotion rather than fundamentals. And most of all, the return of easy money, low interest rates, and massive debt. Global debt reached over $300 trillion in 2023, an all-time high. Housing affordability has collapsed again. The same greed, the same overconfidence, the same blind faith, and this time it's different. It's never different. Every financial crisis has numbers, but the true cause is always human behavior. We repeat the same cycle. Euphoria, when everyone believes they've found a new formula for wealth. Complacency, when warnings are ignored. Panic, when the system collapses under its own weight. And finally, amnesia, when the world forgets and starts all over again. So, what can we learn from the crash that nearly ended modern finance? First, complexity isn't safety. The more complicated a system becomes, the less anyone truly understands it. If you can't explain an investment in one sentence, it's not safe. Second, incentives shape outcomes. If bankers earn bonuses for taking huge risks but lose nothing when those risks fail, disaster is inevitable. And third, the next crisis will look different. but feel the same. It may not start with housing, but the root cause will be familiar: greed, leverage, and human overconfidence. The 2008 crisis wasn't an isolated tragedy. It was a preview, a glimpse of what happens when greed outruns wisdom. Today, markets are again inflated. Debt is higher, and trust is weaker. The question isn't asterisk. If asterisk another collapse will come, it's asterisk when asterisk. And the real mystery isn't what caused the last crisis. It's whether we've learned enough to stop the next one. If this story made you rethink how fragile our world economy really is, then share it, discuss it, and stay curious. Because the moment we stop questioning the system is the moment it breaks again. Thanks for watching. Don't forget to like and subscribe for more deep stories that reveal the hidden side of history, money, and power.